Welcome to WMRE's Common Area Podcast. This podcast is brought to you by the award-winning editorial staff at WMRE. Let's jump right into this week's podcast.
Hello and welcome to the Common Area with your host, David Bodamer. David, how are you?
I'm doing well. It's dog days of summer in Brooklyn. We're in a bit of a heat wave here. I'm settled into my new apartment, which is, given slight mentions of that on recent podcasts, right. But, now fully moved and settled and just, looking to get through the rest of the summer. How are you?
Well, I'm good. That's no small saga with that move. That is a huge issue, moving from one place to another, especially in today's market and all that. You've upgraded your apartment. You've upgraded your computer. You're on a roll here, David. I'm excited to get going with you. And you've got two guests today, right?
That's right. Yes, we have with us two guests from Newmark, Lisa DeNight, who is the head of industrial research, and Kyle Roberts, executive managing director. Welcome to the podcast.
Thank you very much.
So we're going to talk about the industrial sector and some, broad views of that, as well as shine a light on some research you guys have done. But before we do that, just wanted to give you both an opportunity just to tell the audience about yourselves.
Go ahead, Lisa.
Great. Well, my name is Lisa. I'm the National Director of Industrial Research at Newmark. Newmark is a global commercial real estate services firm facilitating client needs across all commercial property types. But my specific niche is industrial, and I help our industrial experts navigate the market and its many challenges and opportunities through data and insight. And we have hundreds of industrial professionals across the country, and it's so rewarding for me because I get to have a conversation one moment with a colleague in California, and another moment a colleague in Cleveland, and then a colleague like Kyle in Salt Lake City, and they're all talking about the same trends. And so these recurring themes emerge, which my team then addresses through our research paper series, through our thought leadership, through market reports. And it's just a great opportunity to be able to channel very quickly what our boots on the ground are saying about the market to a national perspective.
This is Kyle Roberts. I'm Executive Managing Director at Newmark. I have been in the business for about 27, going on 28 years, and am a full-service industrial broker advisor, touching all aspects of industrial real estate, from supply chain optimization efforts for occupiers through land acquisition, development consultation, lease up, and then ultimate disposition with my team of 12 here in Salt Lake. And I also spend quite a bit of time in a leadership role with Newmark on our industrial platform since becoming a part of Newmark approximately 8 years ago. I have been a member of either our industrial advisory board or its prior iterations, which is the broker-led body that sets policy initiatives as well as the strategic direction of the industrial platform. And my role within that has historically been to be very focused on data trends, all of the supporting iron sights that we look at to predict where markets are going and why, and then also to understand and communicate those trends to our clients and other interested parties.
Cool. So thank you for that. The industrial sector, as no secret to our audience that it's been, the hottest sector, right up there with multifamily, throughout the pandemic, coming out of the pandemic. Vacancy rates remain microscopic levels around the country. There's this robust construction pipeline, and that's happening even with this broader context right now of the Fed trying to deal with inflation and rising interest rates. There's a lot of, so I guess I thought it would be a good time to kind of check in on some of these trends and perhaps some of the stuff that you've shined a light on recently. Like, there was a recent report that you put out around the impact that construction timelines are having on the development pipeline. So maybe that would be a good jumping off point to just talk about what is the status of industrial development, what's impacting it, and what can we expect to see?
So there were so many conversations had over the past 6, 8, 12 months about the increasing challenge of getting a building up and out of the ground. Everything from sourcing materials to getting the labor in place to actually construct these buildings. And then even before all of that, the entitlement processes to actually get this building approved to be built. So the piece that we've most recently put out was, as you referenced, about the construction timelines really lengthening and how that both the deliveries and the overall volume of construction we have underway nationwide now. And it's very interesting to see when we did talk to all of these local markets and developers and brokers in those local markets, on average, how much the construction timelines have shifted from pre-pandemic periods. On average, it's about 2.5 months more to go through entitlements now than in 2019. And in addition, another 2.5 months on average to actually construct these buildings. And that has directly impacted our pipeline because we have over 600 million square feet under construction right now. That is by far a record volume, but our deliveries have been so muted in response. So there's this big disconnect from tenants who really need space now, but it's delivering so in drips and drabs, relatively speaking. And so we really wanted to quantify that trend and understand where it was going directionally too. When you see a pipeline of that size, you kind of wonder what's going on. And so the interior dynamics of the actual construction timelines were important to get down on paper so we can understand how that will change going forward.
And so if you add 5 months, what is that? What is the total timeline then with that extra 5 months that you just mentioned, the 2.5 for entitlements and the 2.5 for just the construction process?
Yeah, so it actually varies pretty significantly from market to market. So we looked at around 15 markets across the country, a nice mix of both primary and secondary and tertiary markets to see that the trends were the same in terms of lengthening timelines in general, but just how much those timelines lengthened did vary quite significantly. So, for example, in Dallas and in Houston and Texas markets, you can still get a warehouse, entitled in less than a year. You can still get it built in less than a year. But if you go to a market like Southern California, it's taking significantly longer in both the entitlements period and in the active construction timeline. The Inland Empire, for example, it took about a year on average prior to the pandemic for entitlements to be put in place. That shifted to around an average of 18 months now. Similarly, the active construction timeline was around a year. Add on 3 months to that. So in total, you're looking around 2 years for a process that took significantly shorter pre-pandemic.
And the projects that are in the pipeline now, is there a breakdown between how much of that is spec construction versus how much of it is being built specifically for somebody? And then how does that all with I would like to understand the breakdown of that, and then also understand then for just given the low occupancy rate, what that means for occupiers who are looking for industrial space right now.
So the breakdown between built to suit and speculative space in our construction pipeline has hovered in the 70% range, speculative to built to suits. So over the past year or so, it hasn't really varied all that much from 72 to I'd say 77% on any given quarter is speculative versus built to suit. And in terms of making space now that's the hard part, because you literally can't build space fast enough in some of these markets where the barriers are so high to entry, like say the Inland Empire, or other land constrained markets like northern New Jersey. So there is a disconnect, and in fact we've seen that in our quarterly net absorption numbers. They've been extraordinary over the past 5 quarters. It's actually topped 100 million square feet, which you did not see prior to the structural shift of the pandemic. That being said, the absorption would have been higher if our deliveries had kept pace and were not being dragged down by the supply chain struggles, the difficulty in sourcing labor. All of that has made it more difficult for tenants to get the new space they need in the course of the past 18 months.
And what I think the nuance in those data points that is often lost, and I think it's reflective of what both demand has been and the challenge that occupiers have, particularly people with titles like vice presidents of logistics, and that the difficulty is, one, you're forecasting occupancy on inventory that's delivering maybe much further out than what you would likely or would optimally want to have it delivering to occupy it, but you're also trying to forecast what are the transportation and labor impacts around when that specific component of inventory or regional inventory is being delivered. If a supply chain study says that you need to have X amount of square feet in this location, and there's been just so much volatility in both the labor markets and in the supply chain, it's made it difficult for people to forecast, and that has, in the exuberant kind of run up of moving from just in case to, or rather just in time to just in case supply chain methodology, what's happened is users erred on the side of taking more faster if it was available. And so the nuance in the deliveries is the amount of pre-lease increased. So while it's the build to suit or owner occupied amount of the inventory has remained relatively consistent over time, pre-pandemic, post-pandemic. What's changed is the amount that has pre-leased relative to building deliveries, and that ratio has increased. And it's increased because of the need to have certainty that a footprint can be delivered for a company that has determined it needs a footprint in a specific geography.
So given this, what we're seeing in the macro and economy versus given the policy decisions that are happening and overall the plans around the interest rate hikes we've already seen, the plans, the expectation that we'll see more, the attempts to slow inflation, which we saw even today's numbers saw maybe that the first signs that maybe starting the attempt to slow inflation may be beginning to take root. How is that impacting these dynamics that you're describing?
That's a very good question, and I think the heart of what we're focusing our time on, both understanding and forecasting the impact of. If we can agree that industrial real estate is ultimately the real estate of things, it's things being made, being stored, being packaged, being delivered, then ultimately either direct to consumer, direct to business, or to a brick and mortar retail outlet for sale. The demand for space is going to be directly linked to what inventories are, right? How much of it do you need in order to sell it? And companies are constantly balancing the amount of inventory that they need to both have a good enough cushion to withstand any kind of structural shifts that occur like we saw during the pandemic, but also not over inventorying to the extent that it becomes a balance sheet burden for those companies. So the simplest metric to look at to determine what does forward-looking absorption and the health of the industrial market look like is to look at consumer spending. At the end of the day, in an economy that has 70% of its GDP based on consumption, you can look directly at the increase or reduction of consumption, and that informs what will likely happen with inventories. You've seen a great number of brick and mortar and e-commerce companies make announcements in the first and second quarters, effectively declaring that they are over inventoried, that consumption is not keeping pace with the level of delivered inventories, and that has many companies trying to execute a strategy of relieving the oversupply of inventory that's ultimately going to have an effect on price. And if you think about kind of the nuance within inventory, is you can look at total dollar volumes, but they aren't really a good indicator in a hyperinflationary environment, because the relative cost of each individual unit of whatever it is that's being sold, you can sell the same dollar volume, but if we round inflation to 10%, you're only selling 90% of whatever the widget is to create the same dollar volume of sales. So historically, that has been the metric that a lot of people have utilized is sales volume. But you can't use that in today's environment. You really need to look at the units that are being sold. And so we have a kind of a double whammy for inventories that's occurring, where consumption is reducing. It's anywhere from 7 to 9% year over year in total U.S. consumption of consumer goods, and at the same time, that dollar volume represents somewhere on the order of only 90% of the actual units that would make up that consumption being sold. So you can imagine that companies that are inventory reliant are having to find religion, for lack of a better term, as to what is really the right footprint that we need. In prior cycles, to use that term relatively loosely, as they're all different, but where there has, I can just say, periods of rapid change that manifest as cycles, we typically will enter a period of user behavior that's referred to as supply chain optimization. So it's moving away from the frantic acquisition of space for the reasons we talked about before. You mean the safety is just lease it while it's there, and maybe it's more than what you need, but you may not have it, so you got to do it, to what do we really need? And if you think about consumption patterns, if you're not selling as many things, particularly those things that are high dollar volume, furniture, large electronics, things of that nature, that have over recent history become just in time, same day delivery, we'll set up the furniture in the backyard and take away your old furniture. All of those things are some of the inventory segments that are hardest hit. You probably don't need it to be next day. You probably don't need it to be arriving within a 12-hour or a one-day drive cycle for your transportation. So what that's causing companies to do, and it's what's buoying absorption in markets like Texas, and others that have a significant amount of supply delivery, but the relative rate, the rental rate that's associated with it, as well as the regulatory environment and the labor markets, are supportive of doing consolidation. So you may have users that are actually reducing footprint and concentrating inventory that does not necessarily need to be a sustained quantity of inventory based on sales, and then are going to be decommissioning and moving out of some facilities that were more just in time or same day in orientation. And that we're entering that phase of the market. It hasn't manifested itself yet, but we're seeing the network analysis being done. We're seeing clients requiring a tremendous amount of data to forecast what rents are going to be in various markets, and where are those opportunities that exist for them to be able to consolidate large amounts of inventory in markets that are less expensive to occupy in, because you can pretty well get anywhere in the United States within a 2-day drive cycle. So that's one of the major shifts that's occurring right now.
So yeah, that's a lot.
Sorry.
Yeah, no, for sure. No, but I mean, it just gives people a sense that, you think about this industrial sector. It's not. I mean, I think even the fact that I'm still using the word industrial. I think there's more of a move to saying logistics real estate, just
Sure.
Because it gets to this point that it's we're not just talking about plain vanilla boxes anymore. We're talking about a sophisticated supply chain that's more integrated with consumers, and and that this whole sector has really been modernized and transformed a lot. And so these variables are kind of constantly coming into play for the users of this space, this is not just this is a very complex business, and managing this stuff optimally is kind of a, it's juggling act that's being affected by all these factors that we were talking about before.
It's absolutely right, and it's inefficient, right? If you think about real estate in general as an asset class versus other investment vehicles, where you can look at supply and demand factors that might affect movement in price of those assets, ours in real estate is one of the least efficient. If it takes 24 to 36 months in a primary market, or 18 to 24 months in a secondary market to deliver inventory, a lot can happen in that time period, right? So I think the crux of one of the takeaways from the report that Lisa drafted relative to the time it's taking to deliver is it has actually provided a natural retardant to overbuilding markets, whereas in historical time periods, when there's kind of the lemmings to the ledge mentality of get into this asset class and do whatever it takes to get into it, and you have that kind of feeding frenzy, there are some, real barriers to preventing a rampant overbuilding scenario. And I'm hopeful that what we see out of this, and I believe it will occur, is some restoration to something that's closer to equilibrium. Ultimately, that does see a slowing of demand in some ways, but in order for the market to remain healthy, it just needs to be that which is delivered, and can it be absorbed in a reasonable time period? And there isn't anything on the horizon that suggests that it won't, but there are things on the horizon that suggest that companies are really struggling with a change in consumption patterns that are caused by inflation, and then also exacerbated by movement and cost of funds. It just leaves less in the wallet to consume, and companies are having to react to that new normal.
So what does then this mean for investors? Say you're trying to think of, looking at putting some money in real estate right now and looking at the industrial sector versus some of the other major or minor sectors. Is industrial still a place that you see investors wanting to get into, that you're seeing different kinds of capital target this space?
Yes, absolutely. So again, just back to the kind of original thesis of industrial real estate is the real estate of things. And if you believe that that our population base in the United States is going to grow, and there are certainly geographies where population growth will be more prevalent than in others, but population in general, and if you believe that our economy is going to remain consumption based, and I haven't talked to anybody or read anything or investigated anything that suggests it's going to be the opposite of that for the foreseeable future, then you have to believe that stuff has to get made, stored, packaged, and delivered from someplace. So the only shift that's occurring that we see in the market right now is not the level of interest in the asset class, but really where the interest is coming from. Mm-hmm. When you have and part of that is really reversion, it's trades, right? Institutions are having an extraordinarily difficult time right now underwriting development or forward acquisitions, which would be, something you're buying a building that does not have an occupant, but you believe rents are going to be higher tomorrow than they are today, so you're going to buy a building vacant and get that arbitrage. It is difficult for a lot of the institutions that have, such incredible controls and requirements from investment committees and otherwise to bracket and prove what outcomes are going to be in a market where we don't know what monetary policy is where it's going to end, right? Where is the increase in interest rates going to end, and or when is it going to level off, so that pricing discovery that's occurring right now can have a period where it can calm down and people can kind of adjust to what is the new normal. So there's some transactional gridlock that's occurring primarily from the institutional buying segment in what do we have to pay for something to achieve an acceptable return, and then also sellers that psychologically, if it was worth X amount more yesterday than it is today, that's a tough pill to swallow, and it takes a minute for the markets to kind of adjust and decide that they want to continue to do business. So when you have a reduction of sales volume in general, it usually causes some retrenchment of institutional capital, because nobody wants to make a mistake. Nobody wants to act in a volatile environment where it may get worse or may get better, and the consequence of doing something is a significant monetary consequence. What that's allowed for, though, is a lot of the investors that have historically been kind of the mainstay of the industrial market prior to it becoming really an institutional darling. Had a lot of high net worth individuals, family offices, syndicated development groups, or otherwise that have been priced out of the market. Frankly, it's been too difficult for them to compete. They tend not to be recycling capital the way that institutions are, and they have a much more long-term view of markets, and their hold horizons may be generational, not 3 to 5 years. So for those groups, the ability to underwrite in today's environment is actually getting easier because they're not reliant on exit cap rates.
Right.
And the inability to forecast what those are going to be 24 to 36 months from now, that's tough for anybody to do. So those that have that very long-term view of a market, that are investing on an individual market's fundamentals rather than, simply the recycling of capital, it's really opened the door for that segment of the investor market to become a much larger player, and we're seeing that in deals that we're marketing, deals that we're involved with, all over the country.
Interesting. So a little bit of a reshifting again in who can be moving and who isn't right now.
Exactly right.
Okay. Well, we've been going for a good chunk here, so I don't want to take too much of your time. But if there are any other points that, there's so much obvious fodder to talk about in this space, but any kind of key takeaways that we haven't talked about that either of you want to highlight for the audience, I wanted to give you a chance to do that.
I think the single biggest focus for us right now in trying to forecast and predict where market movement's going to go is really what's going to happen with consumer spending. That's the bellwether indicator for us. There are, depending on the direction that political winds blow, if there is a subsidized investment in manufacturing infrastructure that happens in the U.S., I think that's a very good long-term investment for industrial real estate fundamentals. And we didn't talk about, but what we're seeing is a huge resurgence of manufacturing interest to our partner border countries in Canada and Mexico, as well as in the U.S. So I think the nearshoring and reshoring of manufacturing capacity is going to alleviate some of the potential disruptions to the supply chain that can create so much volatility in our markets. And that's happening, but it takes 3 to 5 years to really manifest and build a plant, debug it, get it producing whatever the widget is. But it's happening.
So that may be a good thing we could bring you back on the podcast. We could talk more about that trend at another time.
Sounds good.
But Lisa, is there anything else you wanted to add?
Kyle touched pretty much anything that was top of mind for me. I would just encourage interested parties to visit Newmark's website at nmrk.com. Under our research page, we keep all of our industrial and other commercial property type research top of mind, and we're always producing what's top of mind for our clients and our internal colleagues in a easily digestible form. So that's the only addition that I would make.
Cool. And we'll put in our show notes some links as well to the most to that part of the site, as well as the research report we referenced. We'll try to get that all in there so folks can see that. So yeah, with that, I want to thank you both for taking time out of the week to talk about your work.
Thank you, David.
Thank you very much to the audience.
Lisa and Kyle, this has been fantastic. Thank you so much for joining David on the show today. I always learn a lot, as the audience does, I'm sure, as well. David, thank you for facilitating this and getting this podcast going and doing all that you do for those that are listening to us. Of course, our last thank you is for you, the listening audience. Thank you so much for tuning in and listening to the Common Area Podcast with David Bodamer. If you have not subscribed to the podcast yet, please click the subscribe now button below. This way, when David comes out with a new podcast, it'll show up directly on your listening device. And we humbly ask that you share this podcast, rate it, and leave a review, as this actually helps other people find the show. Again, thank you so much for listening today. For everyone at WMRE, this is Eric Johnson inviting you back in 2 weeks for all the stories that matter to you. And we'll talk to you soon.
Thank you for listening to the Common Area Podcast. Click the subscribe button below to be notified when new episodes become available. The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of WMRE or Informa. The content has been made available for informational and educational purposes only.